Hi, everybody. Welcome to the Retirement Fingerprint Minute. Today, we're going to talk about market risk. I can't tell you how every day we see clients taking too much risk, too little risk, and a lot of people want to know how much is too much risk and how do I figure it out? So, the first thing that we look at is what we call age based investing or looking at situational. Where are you in your life? And what's the time horizon when I may need this money? And we talk about investing in terms of silos or buckets. And really, how much money should I have? It boils down to how much money should I have in a growth style or growth bucket versus conservative. And if you have all your eggs in one basket, you better have a lot of time. Because at the end of the day, if we have a stock market crash or your investments go down, we need to make sure that that money can be there to re-earn itself. And if you have all your eggs in one basket and you need to live off that money, that becomes a problem. And we see a lot of people either have all their money in stock or all their money in cash, and they don't know how to get off that ledge. The key is to have a plan, not just a portfolio of stocks or a product, but actually have an overall plan. And how you do that is you determine how much should I have in growth versus conservative. And the starting point is what we call the rule of 100. If you take 100 minus your age, for example, if you're 60 years of age, 100 minus 60 is 40. That says you should have no more than 40% of your investments in the growth bucket. The concept is as you get older or as you're closer to needing or wanting the money, it should be more and more conservative. That's a starting point, a rule of thumb. Definitely not the same for everybody because everybody's situation is different. You may have pensions or rental income, so you could take more risk, or you may want to leave money towards a legacy behind a family and you want to alter that. But that is a starting point. And then from there, we look at and we ask, what is your risk budget? A real thing that you need to think about is if the stock market went down like it did in the financial crisis in 2008, how much can I afford to lose? Now, none of us like losing money, but in reality, if everyone else loses half, what do I want to go down? So if I have $1 million, is my risk budget 100,000, 200,000? Because a lot of our people we see out there, if in 2008 you had $500,000, well, now you have $1 million because we've had, plenty of time since 2008, 12 years. That a decline of 50% is a lot more negatively impactful than what it was on a decline on $500,000. So you want to determine what is your risk budget. You want to build a plan around that with the most amount of upside and make sure that you have a diversification. In the last 12 years, it's benefited you not to be diversified and have it all in growth. Now, for a lot of clients in their 60s or people looking to get ready for retirement, you want to start taking chips off the table and making sure you have a balanced plan that if you did have a financial crisis, you have money in a conservative bucket to live on so you can let the growth money continue to do what it's going to do. Hopefully this helps. That's another episode of the Retirement Fingerprint Minute, and we look forward to next time.